The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Geopolitical risk bubbles back up and stocks melt back down. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the United States. That rebound that we saw yesterday, we've pretty much taken it all out today on the S&P 500, down by about 0.6%, being led lower by big tech. The NASDAQ 100 down by about 0.7% here. That's boosting volatility when it comes to this equity market. You can see the VIX back to trading with a 20 handle here, and you are seeing a little bit of enthusiasm come into bonds. I mean, we're pretty much flat on the day, but we did see a sell-off earlier in the day. That has since reversed. The 10-year Treasury yield currently at 407, Romaine.
Yeah, that rise higher in yields, that move lower in stocks. Some of the sentiment slide that we're seeing today relative to the buy the dip the mood yesterday, a function of that U.S. military buildup in the Middle East, raising speculation about an attack on Iran. Brent crude futures, the priciest since July. The VIX creeping back toward its highest levels of the year. The S&P now facing another test of support at that 100-day moving average. Also dampening sentiment out there are the ripples from asset manager Blue Owl, telling investors it would restrict withdrawals from one of its private credit funds, a decision that's reigniting months-long speculation about the true mark-to-market for what they are actually invested in. Shares of Blue Owl, which had already lost half their value in the past year, sliding again today, and that's dragging down peers like Yared, like Apollo, like Blackstone, KKR, and TPG. All this coming as investors already skittish to a certain degree about that key GDP report scheduled for tomorrow morning and a potential Supreme Court ruling on Trump's tariffs. Tariffs that so far haven't actually narrowed the U.S. trade deficit, a gap that fresh data today show now sits among its widest in modern history. The tariffs have also done nothing to boost domestic manufacturing, with jobs there falling in 12 of the 13 months since Trump returned to office. Now, the president today touring the manufacturing region in the state of Georgia ahead of a speech this afternoon that he says, Katie, will be about the economy and affordability.
Well, let's kick all of it off with Gargi Chaudhuri. She is Chief Investment and Portfolio Strategist of the Americas over at BlackRock. Lovely to see you in studio, Gargi. And let's start with one of the words that Romaine used, skittish. It feels like that is becoming more and more appropriate to apply to this equity market, particularly when you take a look at tech stocks. I'm curious whether when you look at the balance of risks right now, whether that's going to spread and whether that's going to spread potentially across asset classes here.
Sure. Good afternoon, guys. Great to be here. So I was trying to think earlier today of all the news flow that we've received in just about 7 weeks of this year. What has actually changed, right? So to come back to your word skittish, if the market's skittish, is it because fundamentals changed, or is it just a brief positioning sort of move? And I'd say from a fundamental perspective, you know, all of the data has still pointed to strong underpinnings in the economy. So if you look at the industrial production data or the labor market data, all of that's still good. One can argue that inflation coming down in a faster pace than expected, also good for policy support. And earnings on a more micro front have been very strong. So when I think about the reaction function in the market, can we just maybe chalk it down to positioning driven? Can we also chalk it down to some of the rotations that are taking place within the large tech space and the AI theme in particular? So I think that's what we're contending with now, 7 weeks in, and not necessarily a strong move based on fundamentals getting weaker.
Well, I'm curious how you're weighing things right now, because you mentioned the fundamentals of this economy, and certainly it looks stronger than perhaps a lot of folks anticipated when it comes to what we're seeing in the labor market holding up, inflation, you know, coming down, maybe at least not accelerating here. And when you weigh that against what we're seeing when it comes to some of these existential AI fears working their way across industries, I mean, how does that leave you and how you would position in this environment?
Sure. So we're having a lot of conversations with our clients with respect to our year-ahead investment directions that we came out with about a month ago. And what we'd focused on a lot when we had that conversation with clients and that content was, you know, looking for ways to diversify within the AI theme. So not necessarily move away from AI, because obviously we recognize that that's going to be a big driver of of productivity, of GDP, and of course of earnings growth, but diversifying within that theme. So what might that look like? Number one, think about other parts of the value chain. So really think about AI infrastructure, for example. That's something we focused on in our January outlook. We also talked about looking at EM as another source, not just of AI diversification, but another source of earnings growth in your portfolio. If you look at the first 7 weeks of the year, it's already $37 billion in inflows in the emerging market equity complex.
Yeah.
Just in 7 weeks, the fourth largest inflows in EM, which is pretty remarkable.
When you look at some of those inflows in EM, though, do you see that as sustainable, or is that just kind of a function of the relatively higher valuations that we have here in the U.S. that maybe people were afraid of?
Yeah, it's a good question.
Yeah.
I don't think it's necessarily related to valuations, because if you think about some of the parts of the market that many people point to as lofty, if anything, those valuations have actually compressed more recently and actually, frankly, even over the course of 2025. So it's not a valuations argument. I think it's very much around recognition. When clients look at their portfolios and when we analyze their portfolios, we see this structural underallocation to EM. And then when you have a year like 2025 and you recognize that you have a 12% underweight versus your benchmark, this is sort of a way in which you can get back at least to benchmark. So that's number one. And the fundamentals remaining very supportive.
I know you said that not a whole lot has changed, certainly over the last year. I mean, obviously, underneath the surface, there's a lot that's moving around. But the overall arching themes are, go back to that report, though, that you did put out last month, which I read. And I am curious as to whether you anticipate maybe having to just revise some of that to some degree or another, if not the report itself, but certainly in your own head internally over the next couple of months.
Absolutely. Listen, the data's changing in front of us all the time. We should all be thinking about the ways in which we've revised our previous thoughts, even if that was 2 weeks ago. One of the things that I'm thinking about now is the way in which companies are reacting to CapEx data or CapEx announcements that are coming out during earnings season, and to what extent that is going to continue, and to what extent we should rethink what type of AI, what type of defensive AI you want in your portfolio. So even thinking about just looking at technology, broadly looking at semiconductors and hardware as more of the defensive parts of AI that have actually exhibited such. The beta to broad technology has actually come down. Is that something you should be gravitating to? So still staying within AI and tech, but moving to the more quote-unquote defensive parts of it with something like a semiconductors or a SOX ETF.
We only have about a minute left, but I do want to bring in treasuries to this conversation because you point out that bond correlations to equities remain less reliable than previous cycles. That's certainly been seen as being true. So what does that leave as sort of the hedge in this environment? What asset class really serves as that sort of function here?
Sure. So less reliable. So you're not getting that every single day. But still, in periods of risk off like this, last 6 weeks, you do see rates, especially the belly of the curve, giving you some sort of income cushion. So that's number one. Seek income. And then I would say number two, diversify those diversifiers. So really look at asset classes like gold, silver, and liquid alternatives, which give you that protection without taking a lot of beta.
All right, Gargi, great to have you. Gargi Chaudhuri, Chief Investment and Portfolio Strategist of the Americas over at BlackRock. She was talking a little bit earlier there about the AI and data centers. We're going to talk to one of the big beneficiaries of that boom, building materials giant CRH, riding the global construction tailwinds. That company says that could persist through the year. A conversation with its CEO when we come back after the break. This is Bloomberg.
Shares of CRH are up on the week after the building materials giant posted fourth quarter adjusted EPS and revenue in line with estimates. Joining us live in studio to discuss, I'm pleased to say, is the CEO of CRH. His name is Jim Mintern. Jim, it's great to see you.
Great to be here, Katie. Romaine.
Let's talk about the hot topic of the past year or so, even more than that, data centers. Because on the call, your COO mentioned that currently you're involved in over 100 data center projects across the U.S. And I'm curious, I mean, especially with the state of the equity market right now, what would you say is the sustainability of that demand, which up to this point, of course, has been quite high?
Yeah, we're active on over 100 data centers right now. If you think, actually, 85% of every data center at the moment in the US is within 25 miles of one of our facilities. So it's an important part of our business within our reindustrialization segment. So for us, Katie, we're a bit maybe different to some of our peers. We supply the building materials into the construction of it. Construction is estimated to account for about 15% of the total cost of a data center. Now, what we do is that we're often very first on site, because if you think about the water, energy, communications infrastructures that have to go in to support a data center, that's our first part of the project. So we come in with a lot of the subterranean concrete structures that support the critical services. We then come with our aggregates, our concrete, and ultimately pave the road, the asphalt in and out. So it's a busy part for us. We've got good visibility, out for certainly for 26 and probably into early 27.
Right.
We're certainly busy in terms of our backlogs.
Well, that's exactly where I wanted to go, and it's the question of visibility, certainly top of mind for investors. You mentioned 2026, 2027, pretty good visibility there. Beyond sort of that 12-month time frame, do you still have that good measure of visibility, or is it a little bit more murky?
Yeah, I would say it's good visibility probably out to the first half of 27. Again, for us, in CRH, by far and away our biggest exposure is infrastructure. Right, so but within the reindustrialization space, data centers, and indeed, complex manufacturing, whether it's chip plants, that's where we're busy. They tend to be maybe more kind of multi-year projects, maybe 2 to 3 year projects. And for us, particularly around, say, a lot of the complex reshoring of manufacturing, the building of the plant itself is fantastic. But actually, we see time and time again, it's the fill out of the facilities around it, the residential, the retail around that. So we kind of get a boost for maybe 3-4 years post the facility itself afterwards. So, yeah.
I am curious, though, what about the transportation side right now? And I am curious mainly because we've seen some fits and starts in certain projects, primarily because of issues with federal funding and the continuity of it. Has that affected you at all?
It hasn't at all, Romain.
Yeah.
No. Clearly, we're, from a federal funding perspective, the IIJA bill, there's only about 50% of that, from a highway perspective, actually hit the street at this stage, right? Okay. So there's going to be a long tail on that. Now, that bill expires this year, right? But already in Washington, there's good discussions going on, both in the House and in the Senate, right, with Chairman Graves and Chairwoman Capito on that. We've got Secretary Duffy, who's quite supportive of a new multi-year highway funding program. So, and typically infrastructure funding has been, bipartisan support. So, we're quite hopeful there'll be a bill this year. If there's not, we'll kind of, unfortunately, we've been here before a number of times, you get a continuing resolution. But for us, the continuing resolution steps off a record year this year for federal funding. So it's a good place to start. So the outlook on infrastructure funding for 26 and 27 is good, right? Yeah. And actually linking it back to the last discussion, I mean, to have all these data centers and indeed complex manufacturing is great, but if the infrastructure support isn't there to support that, that's a key part of it too.
I do have to ask you about your costs and particularly some of the inflation that we've seen in aggregate materials. Is that still rising? Is that under control? Is that hedged? How does that work for you?
Yeah, we are the biggest producer of aggregates in the US, right? And we own more rock than any company in the US as well. So for us, in terms of our main input costs are around labor, around external services and maintenance parts. We're continuing to get inflation in that, in those particular areas. Right. Now, we're looking forward to 2026 for our own price increase to recover that inflation of kind of mid-single digits.
Is that offsetting or is that one side offsetting the other?
That together with kind of performance initiatives is offsetting it, and we'd be looking forward to another year of margin expansion, yes.
I also want to talk about your M&A strategy because you've been particularly acquisitive. I think you completed close to 40 deals last year. The number expands to something like 100 over the past 3 years. Do you plan to keep up that pace? And if so, what sort of areas are you looking at?
Yeah, we do, Katie. I mean, 38 is not unusual for us, right, in terms of a run rate. We did 4.1 billion in the year, and the largest was the eco-material deal in September. We set out in our investment day a few months ago that we had a financial capacity of about $40 billion out to 2030. We expect to invest about 70% of that on the growth side. Where we will invest it is in the faster growing markets within CRH, so kind of South and West US, also Central Eastern Europe, but then within our 4 key platforms. So that's within aggregates, cementitious, water and roads. So that's where you should expect us to invest. And the pipeline's good. On the back of the 38 deals last year, the pipeline into 26 is good. We've got good optionality.
I do have to ask you about your multiple listings, if you will. Obviously, you trade here in the U.S. Shares are doing well. There's a big disparity between the value of your shares here and the value of your shares on the London Stock Exchange. Are you planning to delist anytime soon? Yeah, we announced this morning, Romain, that we're undertaking a review of our listing in London. We listed about
just over nearly 2.5 years ago in the US in NYSE. It's gone very well, right? But our daily trading volumes at this stage is kind of high 90%, so we're in New York. So we'll undertake a review over the next number of weeks and come back to you on that.
All right, Jim. Always appreciate it.
Thank you very much. Thank you.
Jim Mintern. He is the CEO over at CRH. A closer look there at the infrastructure build-out. Some breaking news crossing the wire. This on Bank of America and a deeper dive into the world of private credit. Bank of America saying that it's going to commit $25 billion to private credit deals. Now, this is according to people familiar with the situation that Bloomberg reporters spoke to. This involves a reshuffling of a few key jobs at the top, and more importantly, a $25 billion commitment to pursue more of those deals. We'll get you some more details on that. And we're going to talk a little bit more here about the economy and one of the biggest U.S. trade deficits since the 1960s. Is that complicating the economic backdrop? Well, we're going to hear from the acting chairman of the White House Council of Economic Advisors, Pierre, Yared, when we come back after the break. This is The Close on Bloomberg. There's a big GDP report coming out tomorrow that is expected to show that the U.S. did finish 2025 with some of the strongest growth that we've seen for quite some time, at least for a country of this side. But overshadowing that is a big debate right now about the impact of tariffs. Just this morning, we learned that the trade deficit last year held at its widest level since at least the 1960s. That's according to data out of the Bureau of Economic Analysis. $901 billion gap, reflecting a surge in AI investment with computers and accessories accounting for a large portion of the imports. And of course, now a big tit for tat ahead of a potential ruling by the Supreme Court about those tariffs and, more importantly, the economic impact thereof. Let's bring in the acting chairman of the White House Council of Economic Advisors onto the program now. Pierre Yared joins us from our bureau in Washington, D.C. Pierre, great to have you here. The president on the ground right now in Georgia, ostensibly to tout the economy, the affordability. Talk a little bit about, and I know you can't necessarily preview what we're going to find out tomorrow, but when you look at the economic cycle and the economic trajectory heading into towards the end of last year, what did it tell you about its ability to sustain that growth rate in 2026?
Great. Thanks so much for having me. Obviously, we don't know where GDP will be tomorrow, but I'm cautiously optimistic. I mean, if you look at where we were in Q2 and in Q3, the economy was doing extremely well, and it was doing extremely well, as you mentioned previously, in large part because of the amount of investment that we have seen in the economy. And given that investment, as well as some of the activity that investment has inspired, such as the large surge in non-residential construction jobs that we saw in last week's employment report, we can be confident that that level of investment is laying the groundwork for significant economic growth into 2026. And one important thing to note about that growth is that it is really a supply-driven growth, and that's what that investment represents.
I am curious, though, particularly on the demand side, and particularly when it comes to issues of affordability. There's been a lot of talk about the impact of tariffs on the consumer, the idea, and there have been multiple studies showing just how much of the tariff costs is being passed on to regular folks here. I am curious as to whether you agree with those numbers, 90+%, to pick your study, they're all pretty much the same, as well as Kevin Hassett's rebuttal, basically calling it hogwash.
I think we have to understand what those studies say and what those studies don't say. Those studies are pass-through regressions. This is one of the most common regressions that economists who focus on international trade do. Those pass-through regressions tell us what tariffs do to relative prices. That's all that those studies show. However, you cannot deduce from relative prices who is bearing the burden of the tariff. That requires a deeper analysis. That requires looking at
Have you or anyone
wages.
at the Council of Economic Advisors done an analysis of who is bearing the biggest brunt of those tariffs?
You know, the right way to think about where the economy is, given the number of large major macro shocks that we have experienced, is to look at the totality of everything. If you look at tax cuts, productivity boom due to AI, deregulation, trade deals, one can't disentangle from all of these things the singular impact of tariffs. And if you look at the total overall economy, it's coming out, you know, what you're getting is record productivity growth, record, you know, you have wage growth, weekly earnings is extremely strong, particularly in manufacturing, particularly in supervisory manufacturing, where it's outpacing supervisory manufacturing. So I think when you look at the totality of all of the policies, they're resulting in significant economic growth, and they're also resulting in huge wage growth, particularly for some of those sectors that were left dormant during the Biden administration.
Well, Pierre, I have to ask you about the other element of Kevin Hassett's comments, and that was him coming out and saying that the researchers behind this study should be, quote, disciplined. And I'm curious if you agree with that, and if so, what do you think that discipline should look like?
Honestly, Kevin is very passionate about research, just like many of us economists. And as I mentioned previously, the most important thing about the study is to make sure that it is interpreted correctly. And the right way to interpret this study is that it is one of multiple pass-through regressions that many economists do. And so, but you can't deduce from that sort of exercise who is bearing the burden of the tariff.
Well, this does bring us to the topic of Fed independence. We did hear from Minneapolis Fed Governor Neel Kashkari earlier this morning saying that this is basically another step to compromise the Fed's independence, basically. And, you know, when you look across Wall Street, when you look across the economist community, the consensus seems to be that the Fed's independence is under attack. The White House has, of course, come out and said that's not the case. But I'm curious whether the administration is basically operating under a different definition of Fed independence. And if so, what is that?
I think that having criticisms of a study by researchers at the Fed is not an attack on Fed independence. The White House has been very clear about the importance of Fed independence for the functioning of the economy. And I think that looking at comments over specific studies and claiming that this is an attack on Fed independence is a little bit hyperbolic.
I do want to look a little bit forward, Pierre, here. I mean, the president's scheduled to give a speech later today. He's got a State of the Union speech scheduled for next week, speeches that, at least based on what we're learning, is going to focus a big part on the economy. What efforts, what discussions are you having right now about potential additional stimulus for the economy, particularly for the middle and lower income Americans out there?
I'm not going to get ahead of the president and the content of the State of the Union address. What's very clear is that the economy has been doing very well in 2025, and we anticipate the continuing.
Has it been doing well for everyone, for the middle and lower income people, Pierre?
If you look at the wage growth that I mentioned, and if you look at the wage growth in particular relative to inflation, it's been very broad-based. And if you look at the blue-collared workers, particularly manufacturing, mining and lodging, construction, that's where the wage gains have been the most pronounced. If you look at weekly earnings in those professions, that tells you that the growth is broad-based.
All right, Pierre, unfortunately, we're up against the clock. We really appreciate you taking the time today. That is Pierre Yared. He is acting chairman of the Council of Economic Advisors. This is The Close on Bloomberg.
3:30 p.m. in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld.
All right, well, Bloomberg, Katie, was actually the first to report that OpenAI's latest funding round is likely to bring in more than $100 billion. It's a record-breaking financing deal that would give the firm the funds it needs in order to build out its artificial intelligence tools. But there's a lot of concern right now about some of the valuations in the AI space and just when we start to see a return on some of the investments that not just OpenAI, but quite frankly, all these other companies have been making in this space. Well, our next guest, he helps to run Stagwell. It's a digital-first global marketing network that he founded and is the CEO of. And it's actually been trying to help some of these enterprise companies find operational ways to incorporate AI. Mark Penn joins us right now, the chairman and CEO over at Stagwell. And Mark, I do want to start there with regards to what advice you're giving them. Is this about the optics of what they can show, or is this about actual substance and maybe finding something one day on the income statement that shows a return on all this investment?
No, look, I think there's tremendous value in the implementation of AI. I think that we've taken our company, Stagwell, in the core marketing services, and I was chief strategy officer at Microsoft before doing this job, and really said, how are companies going to get value out of AI in marketing, they're going to get tremendous value. We partnered with Palantir, and we're creating products here that basically give them abilities to tap into their data and understand their customers and adapt to those customers in ways that they just never could before. So I think the big problem that people make is they always think about, can we get something more efficient? Instead of new technology lets you do things you never could do before, and that's where the value gets really extracted.
There's a problem, of course, at least, and I'm talking more in the context of publicly traded companies, and of course have to go before Wall Street, every 3 months. And I think that's where some of the skittishness is that it's not showing up in the numbers. But when you talk to some of the executives in the C-suite who have employed some of these tools internally, it does seem to show that they are seeing some type of benefit. Does that benefit, can that be articulated in a way that Wall Street would understand, or at least would actually be willing to embrace?
Look, Wall Street should see that first, you really see the investment itself in the hardware, and then the investment in the software, and then the returns. Wall Street has just gotten way too jumpy. This is the biggest advance really in technology, certainly since the creation of the internet. There's no question about it. Anybody who gets on and starts to do things on ChatGPT or does them, on Claude, now sees that instantly. So why is Wall Street so nervous about something that is obviously so beneficial? They're worried that too much value is going to be wiped out and nothing's created. That's nonsense. Value is going to be created here because, just look at the car industry and the ability now that we're so close to having self-driving cars. Look at, from my business, that advertising is going to come into this space. You see already ChatGPT and OpenAI and others are experimenting with the advertising marketplace. You see how targeting and data use is going to be taken to the next level. And you see how hardware, whether it's a robot or a car, is now going to be controlled in new ways. And the relationship that people have to technology completely redefined. So I think that those Wall Street AI bears are really going to miss out here.
Well, one of the reasons why Wall Street is so jumpy is exactly the chart we just showed when it comes to the enormous amounts of CapEx being planned and being spent right now. I mean, over the coming months, certainly the hyperscalers expected to spend well over $500 billion or so. And I mean, to that point, Mark, do you think that there's anything to the concerns that maybe we are going to see a little bit of overspend here, and maybe even more than a little bit?
Well, but look who's making those overspend. The people who are spending that, and you see the money's flowing into OpenAI, but Microsoft and Google and others, they can afford, and Meta can afford putting that capital to use there. They obviously have determined that that's the best possible use. But then Wall Street is taking it out on things like software creators that are low capital investors who don't need to invest in that kind of capital. From what I see, there's huge demand in the chips. There's huge demand in the cloud. There's huge demand to have the centers. And then there's got to be huge demand in the creation of applications, whether you call it software in a traditional sense or new kinds of routines and agents that have to be created, monitored, and deployed. This is going to create whole new industries. And that is an economic opportunity for investors, not the opposite.
Well, Mark, I'd love to talk a little bit about your business specifically, because you mentioned that partnership that you have with Palantir. You announced that back in November. And when it comes to seeing that flow through to some of your numbers, what is the expected timeline there?
Well, I think we're in the product development phase. We have now 3 major proof of concepts where we're working it with customers. I think we're going to have a real significant product announcement here in the next couple of months here. We're beginning to show it in demos to clients. I think you're going to see significant pickup in that by the end of this year, because we're really beginning to, I think, have those proof of concepts. And these systems are really going to significantly transform the ability of a company internally to take their internal data, match it with the Stagwell ID graph, and make moves that they never could make before.
Hey, Mark, I want to get your thoughts more broadly here on the potential economic impact of this. I mean, obviously, you've got a lot of the extreme sort of scenarios out there. Either this will be our salvation or AI will doom us all. But I thought it was interesting that I believe it was your company put out a report, I think late in December or November, that talked about how about 70% of the CEOs that you had interviewed were actually saying that they actually felt that AI would actually have a material impact on their hiring. Now, they seem to, at the same time, say they think it will have an upside to the economy. And I'm just trying to square the circle on that. If they're saying we're going to be in a situation where we don't have to hire as much, how does that translate into an actual boost, if at all, to economic activity?
Again, they're looking at, are they going to have to hire as much for the old tasks that people used to do? The answer to that is they will not have to hire as much. When I asked them, what are they doing with their capital? Overwhelmingly, the number one thing they said they're doing with their capital now is investing in AI. And that, of course, if I'd asked them 2 years earlier, they put at the very bottom of the list, sustainability and climate change, and they put at the top of the list AI. So it tells you that every CEO is out there thinking about how they're going to get on the AI bandwagon. Now, what does that mean for the labor market? It means that labor markets, different jobs are going to, like every time new technology comes into place, new jobs get created, old jobs get lost, net. I think there's going to be tremendous opportunities. After all, if they're spending trillions of dollars here on infrastructure investment, that's going to flow through the economy.
Yeah. All right, Mark, I have to leave it there. Great conversation. Hope to have you back. Mark Penn, Chairman and CEO over at Stagwell, and, of course, a longtime political strategist. When we come back, shares of Walmart down for a third straight day. This after giving a cautious profit forecast. We're going to unpack that report with one of the key analysts who covers that over at Evercore ISI. Stick with us. This is Bloomberg.
Well, our stock of the hour is Walmart. Shares slightly lower after this morning's earnings report, with the company saying it expects less earnings growth this year than what the street was expecting, given a less predictable economic backdrop. Joining us live to discuss is Greg Melich. He is Senior Managing Director over at Evercore ISI. So, Greg, a pretty conservative guide here, but taking a look at your notes, you write that there's plenty of reasons to get excited about what 2027 and 2026 have in store. What are they?
Well, number one is Walmart's winning with its value proposition, and they're leaning into convenience, which is really recognized across income cohorts. So they're winning new customers, a lot of higher income households. And we think the thing that's really about to set to take off for them is the power of about 20 million Walmart Plus members that they now have. Those members shop more frequently. They have bigger baskets. They're starting to use Sparky, their AI agent, to build those bigger baskets. And so we think there's a lot of momentum behind Walmart that'll help them grow not only top line and share, but expand margins for several years to come.
Are some of those moves right now, Greg, the costs associated with those moves, does that give you any concern?
I think what I like about Walmart is that while they're certainly investing to take advantage of all that, the CapEx number is still right around 3.5% of sales, so it's at the top end of their 3 to 3.5% range. So it'll come in probably 26 billion this year. So there isn't some sort of big step up like a hyperscaler. They're gonna use technology to make their business better and to help serve their customers better with faster product delivered more conveniently. And you can see them leaning into that every day. And then these fourth quarter results, which were quite good. The stock is down, and we've had one of these negative tactical calls on it this week because it has done so well. And the fact that the guide was below the street. We think it was a nice conservative guide. We're actually just north of $3. But we think there is more earnings power in Walmart that is reflected in that guide today.
Yeah, maybe a victim of its own recent success, at least when it comes to its stock market performance. So it's interesting, of course, Walmart kicks off earnings season for some of its peers as well. Target, Costco, some of the names just set to report in the coming weeks. What can we extrapolate out from what we heard from Walmart this morning to what we might hear from some of its peers?
Yeah, it's a great question. The consumer is cautious and very value focused. But willing to spend when they have the right product at the right price. And again, convenience is something that matters to most households. And that Walmart is certainly leaning into that. So One thing that we thought was worth watching is as we get the tax refunds, which we think could be a potential 200 bip plus tailwind to retail sales in the coming months. How much of that would go to the Walmart customer and into their household? So we think there's, again, it's too early to get that, but in the next few months, we'll start to see that. And I think there's some reason for optimism that the consumer, which has had a lot of caution and concern, could start to get a little bit of shot in the arm.
Greg, real quickly, any concerns right now about the current tariff situation as it relates specifically to Walmart and any factoring in of the potential that the Supreme Court maybe reverses some of those tariffs and some of that money flows back to the company?
Yeah, great question. So I think it's a little too early to speculate on what would happen with a SCOTUS ruling and what would happen with it. I know our policy team believes that the other laws would be used to probably recreate 80 or 90% of the tariffs. But assuming that that decision comes down, I look at it this way. Last year, we think Walmart ended up spending about $500 million to potentially $1.5 billion or $2 billion on tariffs that they weren't able to mitigate. So I think of it that way, is that took away a few percentage points of growth last year that maybe they could reinvest in either margin and give back to the customer to drive more traffic or get back in profit. So still too early to say, but that's how I think they'd use it.
All right, Greg, got to leave it there. That is Greg Melich. He is Senior Managing Director over at Evercore ISI. This is The Close.
When I think about the reaction function in the market, can we just maybe chalk it down to positioning driven? Can we also chalk it down to some of the rotations that are taking place within the large tech space and the AI theme in particular? So I think that's what we're contending with now, 7 weeks in, and not necessarily a strong move based on fundamentals getting weaker.
The long-term view from Gargi Chaudhuri over at BlackRock, kicking us off to the close just about 50 minutes ago. But we do have to focus in, of course, on the short term as we count down to those closing bells. Katie Greifeld, a market on the back foot today for, I don't know, a myriad of reasons.
Yeah, off the lows of the session, I will point out when it comes to the S&P 500, but you can see down by about 0.4%. A lot of that weight is coming from your big tech stocks. You can see that in the NASDAQ 100 here. Not seeing too much of a bid come into the bond market. We did, of course, claw back some of the losses we saw when it comes to the Treasury market, but still not too big of a bit, given that you are seeing the VIX rise today. Absolutely.
Not a whole lot of earnings after the bell, at least none really that are going to move the market. Of course, the real big moment is going to come next week when we get NVIDIA and maybe another read on the AI trade. I think Jensen Huang's still bullish on the AI trade.
I'm going to be watching fondly. I won't be here, but I'll be thinking about you.
Where are you? Are you building out a data center somewhere that I don't know about?
I can't comment at this time.
All right. Conflicts of interest there. Anyway, as we continue to count you down to the closing bells, let's bring Alexandra Wilson-Elizondo into the conversation. Co-head, co-CIO of Multi-Asset Solutions at Goldman Sachs Asset Management. Great to have you.
Thanks so much for having me.
Let's first talk about some of the rotation we've been seeing in this market. The idea that even when we've seen these pullbacks on a day like today, money's not necessarily flowing out of the market in any sort of wholesale manner. It just seems to be looking for different pockets of it. What are you saying?
Yeah, I would holistically agree with you. I think on big picture, we're very constructive on the macro. Everything cyclical is being co-signed by what's happening fundamentally. So, whether we look at the $22 trillion of cash that is sitting on the sidelines, the $1 trillion worth of stimulus that's supposed to come to the market, 5 consecutive quarters of double-digit earnings, margins that are double digits, we're really constructive, and we don't see a reason for that to stop. Now, what we are focused on is that there's a lot of volatility of emotion around the AI trade. And that's really getting exacerbated by a lot of the retail flow.
When you hear some of that, and I mean, we don't have to get into the merits specifically of that criticism, but I just thought it was interesting too. We had the Figma CEO earlier on Bloomberg on a different program who was kind of defending the software side of it, which seemed to freak a lot of people out. The potential that the disruptors are now the disrupted here. You think that one maybe was just a little bit, I guess, too much in terms of the way people were reacting to it?
Yeah, I mean, for us, this is it's a spectrum. So you're going to have obsolescence, that's a natural part of a corporate cycle in some cases when you have large, massive tech hit the market, or you're going to just have, companies that are spending so that they make sure that they're the dominant player, and then there's everything in between. But we actually like some cyclical quality, and there's some software names that baby was thrown out with the bathwater, and we're very focused on places where there's security or data and that AI is actually just going to end up supporting it. So, I think the market is in the panic, sell first, ask question later, and then everybody's coming back down to the fundamentals again.
Well, I'd like to talk a little bit about how people are accessing the market more so than the market moves themselves, because I'm taking a look at the notes you sent over to our producers, and you talk a lot about model portfolios, which are basically, strategies packaged together that financial advisors can then buy for their clients. And it's interesting. I mean, Bloomberg Intelligence just had a note on it, basically calling it a $3 trillion allocation machine. And I'm curious, why you think that's becoming an increasingly popular way for financial advisors to basically invest their clients' money.
I mean, just think about the things we've talked about thus far. So the speed of change in technology, AI, the delivery of investment content, whether it's active ETFs, outcome-oriented strategies, all of this stuff, including geopolitics, that needs it's never called more for professional management than it has right now in our opinion. And so, given the mega trends that you see with wealth and the desire to have things managed professionally, it's just really coalescing around a lot of strength behind model portfolio business.
And it's interesting. I'm thinking about a conversation we had actually almost 2 years ago at this point, and you were talking a little bit about GSAM and how you fit into that model portfolio landscape. And you told me at the time that the ambition is to become one of the top 5 model portfolio providers. And I'm curious to know where you are on that journey and whether or not that's still the goal here. Yeah,
so it still is the goal. It's a 2030 goal. When I was on last, I believe we were ranked 9th. We're now 8th. We manage $20 billion in assets. And we're really focused on having the right toolkit to get to the place where we can have the total portfolio solution for all advisor sets. So you saw us make the announcement on the Innovator acquisition, and we're focused on other strategic technological partnerships. So we have every ambition to keep going there, but it's a very thoughtful and strategic process rather than brute force.
I am curious just about demand overall when we talk about, and when talking about investor demand, particularly kind of when you see this sort of decoupling of markets. There was a big story on the Bloomberg yesterday about how Apple basically has its lowest correlation to the rest of the market and since forever. And you can kind of pick any sort of big stock out there, and you're seeing something similar. And it's not just within the U.S., but you're seeing sort of a breakdown of correlations across the globe as well. Does that drive more demand your way?
In terms of the model portfolio business, especially because advisors are looking for someone to help them have the conversation with their clients so that they can focus on other value-added services. And so when you have things like major dispersion breakdowns, or more interest in global macro, what's happening in Japan, the reflation trade, being able to see around corners and to give the content and information, and sometimes the content itself is the alpha for them so that they can have that communication vehicle. That's really what they're looking for in terms of partnering up with someone like Goldman Sachs.
And before we let you go, I do want to ask a quick question about what we're seeing when it comes to demand for private assets. Of course, the big story of the day is Blue Owl, that retail private credit fund, sort of limiting redemptions there. Those types of episodes, those types of experiences, do you think that that's going to sort of take some of the demand out of the market from those retail investors?
No, but it's going to go back to the principles of you have to educate. People have to understand what they're buying, and the manager themselves is incredibly important. So not all privates are created equal. And I think this is a great opportunity. We have a whole education series that we roll out for our clients as it relates to how you allocate to privates, why, what type of vehicle, do you go evergreen, do you do closed end, things of that nature. So I think it's just going to bring to the forefront how important being educated on these asset classes are.
All right, great to have you here, Alexandra.
Thanks so much for having me.
Alexandra Wilson-Elizondo, co-head, co-CIO of Multi-Asset Solutions over at Goldman Sachs Asset Management, counting us down to the closing bells. We are just about 2.5 minutes away from them, and we talk about this idea of a market off the lows of the day, but in the red here, a rotation still afoot with Deere, Quanta, and AMD leading the charge. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. Carol Masser and Tim Stenovic join us right now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A bit of a flip-flop from what we saw yesterday, Carol Masser, with stocks on the back foot, though some of this seems to be tied to fears about what might be going on over in the Middle East.
Yeah, we've definitely seen gold move up above 5,000 again today. We saw WTI and oil futures, the energy markets reacting. So there is some fear. Geopolitical, once again, kind of putting some nervousness back into the trade here.
Yeah, gold hovering around $5,000 an ounce. Bitcoin, though, which some argue is digital gold, other people, Katie, argue it's not anything, is at about $67,000, up it's close to $800 right now.
Yeah, fewer and fewer people arguing it's digital gold, especially when you take a look at the correlations between Bitcoin and gold. I will point out when it comes to this overall equity market, not too much in the way of volume. You know, maybe we'll see a little bit more when we get those GDP figures, and certainly next week when we finally get those NVIDIA earnings.
Absolutely, and at least in the here and now, we are keeping an eye on the economy as well. We got those trade figures this morning. You had some encouraging economic data earlier in the week, and we get that GDP report that basically will show how the fourth quarter, the last 3 months of the year, shook out. Expectations pretty high for that, 2.7% growth, which for an economy our size is nothing to sneeze at.
Yeah, until we get to that next Fed meeting, right? We've got to live from economic report to economic report.
The president also on the ground today in Georgia, expecting a speech from him later this afternoon, ostensibly about the economy and affordability, according to the White House. Right across the screen for most of the major indices here in the United States as we get the closing bells, with the S&P dropping about 20 points, or roughly about 0.3%. The Dow Jones shedding about 270 points, or about a half a percentage point. The NASDAQ down 0.3%. And one of the few bright spots out there today, and it's a minor one, is the Russell 2000, higher actually on the day by about 6 points, or 0.25%.
Ah, that is interesting. All right, let's go back, though, to the S&P 500, if I may. And you did see most names in the index lower today, Katie, about 297 losing ground on this Thursday, 202 to the upside, and 4 unchanged.
Certainly more losers than winners when it comes to what the Circle has to say. You can see a lot of red on the screen. In terms of what did perform well, utilities higher by more than 1%. You could also read that pretty defensively as well. You also are highlighting industrials there, higher by about 0.8%. Energy higher on the day as well, as we sort of parse through some of those geopolitical concerns. In terms of what your biggest losers were, financials down about 0.9%, followed by tech and consumer discretionary shares.
All right. Well, we are getting some earnings, not necessarily the biggest earnings in the world, but we sort of walk through them to give a broader read here on what's going on in the broader economy, and more importantly, specifically in the tech space. Akamai, which I guess makes a lot of the pipelines, if you will, of the internet, reporting adjusted EPS that did beat $1.84 versus street estimates of $1.76. Revenue in line at about $1.1 billion. But for the full year, 2026, the company says expect revenue in a range of $4.4 to $4.55 billion. The low end of that range is in line with the average of analyst estimates. And for the current quarter, the fiscal first quarter, the company sees adjusted EPS in a range of $1.50 to $1.67. That might be why the shares are down. The street was looking for $1.75, so the top end of that range significantly below the average of analyst estimates.
Yeah, Akamai is up about 25% here in 2026, but definitely a haircut if you look at that aftermarket trade. So continuing to track that one. Hey, let's go to some of the individual gainers, if we may. Omnicom. We were breaking down the advertising and marketing company about 24 hours ago. It came out after the close, and this is your number one gainer in the S&P 500, a gain of about 15% here. Biggest intraday move that we've seen since about February 2022. So this is a pretty substantial move in this name. The company did report fourth quarter revenue that beat consensus estimates. Company's board also authorized a $5 billion share buyback, and so we definitely have seen investors moving into this one. Let's move on over to the number two gainer in the S&P 500. We're talking about Deere, a gain of just shy of 12%. It's the world's largest farm machinery maker, and it did boost its annual profit outlook, anticipating a long-awaited upturn in the agriculture economy. So the company increased its outlook for small agriculture and turf, as well as construction and forestry, but its largest segment of production and precision agriculture, they did point out remains under pressure. And then just got to mention Etsy. We were talking about this one too 24 hours ago. Etsy as high as almost 13% intraday, but finishing with a gain of about 9%.
Yeah.
The online marketplace reported its fourth quarter results, but also a very big impact of the company's deal to sell its Depop business to eBay for about $1.2 billion. Yes, Romain?
I thought you were going to do the third biggest gainer in the S&P. You did the first, the second, but you skipped over the third. Quite frankly,
I'm not a 1, 2, 3 kind of gal. You should know that.
Well, there you go.
What is it, Romain? Why don't you do it?
It's Texas-specific land. It was up 10% here on the day. And Katie Greifeld, speaking of Texas, I think there's some earnings out also.
Speaking of Texas, this coming from Texas Roadhouse. That's right. We do have their
two
earnings
companies
here.
known for their role in Texas.
You were hoping for that
Roadhouse.
Texas segue.
There's literally Texas in the name. Let's talk about some of these numbers here. Fourth quarter revenue coming in a bit light, $1.48 billion. The estimate was for $1.5 billion. EPS also coming in a little bit below the year-over-year figure, $1.28 versus $1.73 a year ago. So missing when it comes to its EPS there. It's interesting. They are raising their dividend here. They do see 2026 commodity cost inflation about 7%. We know that is a big deal specifically for a lot of these names in the restaurant industry. And you can see shares down about 0.8%, as we start to parse through some of these numbers here.
Well, let's look at some of the worst performers in the S&P 500 today. Weighing down the index, Booking Holdings, among the biggest drags today. Shares fell to their lowest level intraday, at least going back to September of 2024. Shares ended up closing down by more than 6.1%. The company reported fourth quarter adjusted EPS below expectations. The rest of the results, though, largely above consensus. This is a stock that's $4,000. The company gave a growth forecast, approved a 25-to-1 stock split. D.A. Davidson, Cantor, KeyBank, all among the firms that cut their price targets after earnings. Also, keep an eye on what happened today with Blue Owl Capital. Shares taking a hit after the company decided to restrict withdrawals from one of its private credit funds. It raises concerns about the entire private credit industry, a $1.8 trillion market. Shares down today by 6%. The firm said investors in Blue Owl Capital Corp. 2 will no longer be able to redeem shares on a quarterly basis, and the fund will return capital through periodic distributions funded by loan repayments, asset sales, or other transactions. And finally, watching what's going on today with shares of Klarna Group. They fell by more than 26%. Let's just round that down. Round it up. 27%.
Come on.
This after the company reported 2 consecutive quarters of losses. It's struggling to convince investors to hold on for future profit. Pre-tax loss of $241 million for the last year, despite pulling in record revenue. It set aside more money for potentially souring loans. So I don't know if that's a commentary about the customers of Klarna that it serves around the world.
Yeah, I'm actually intrigued by that story because wasn't the whole idea is that given the short-term nature of these loans, they weren't carrying as much credit risk as maybe traditional banks were, but definitely something to look into.
That's a big haircut today, 27%.
Yeah, it is. It's huge. Just real quickly.
That's going bald.
Tim, what's going on over there?
That's not a haircut. That's going bald. That's a big drop.
That's a full shave.
Yeah, thank you, Katie. Okay, go ahead, Romain. Take it away.
Okay, are you done? Okay. All right, just real quickly here. Yields, no one cares. Anyway, actually you should care because we did actually see for a third straight day the shorter end of the curve, the 2-year yield higher, modestly to be sure here. But that's going to be a big issue, of course, heading into the next few weeks as we kind of count down to that next Fed meeting. A lot of concerns right now about the potential impact of inflation, particularly as it relates to geopolitics and whether that ends up weighing on it as well. Carol.
I actually think you guys have something to share with us.
We do.
Great. Let's get into this because I feel like.
Get into it.
Yeah, go ahead.
Really quickly here,
prediction
markets, it feels like they are eating everything. It's hard to have a conversation without them being mentioned in some form. A really interesting partnership announced today between Tradeweb Markets, which is really all about fixed income trading, signing a deal to bring Kalshi's prediction markets and their event-based contracts, their prices, to Tradeweb. This is really interesting, and I think it just goes to show how ubiquitous prediction markets are becoming. And again, it's interesting to see this specifically from Tradeweb, which again is known for its bond trading, not exactly spiritually similar to what we're seeing on these prediction markets.
How big of a market is this, and how big of a market is this going to be? There are so many places where people can, at this point, place their bets or make their predictions. Is there enough of that to go around to all these companies that are getting in on it?
I don't know. It seems like this is a something that's quickly growing. I mean, you've seen the response from some of these equity exchanges, now from, of course, TradeWebs and some of these debt trading platforms, and certainly from the traditional sports books.
I guess I would say ubiquitous doesn't mean necessarily it's the right way forward, but I guess we're going to wait and see. I'm assuming regulators at some point are going to get involved in all of this a little bit more.
Remain so quiet.
Why are you so quiet?
I'm ready to go, Carol.
Oh, I can tell. All right, that's a wrap.
I have my coat on and everything.
Across platform, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Katie and Romaine continuing on The Close on TV. And Tim and I, of course, on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
When we come back, our coverage here on Bloomberg Television continues. A closer look at some of the biggest decliners of the day, and that includes alternative asset managers, led, or I should say, spooked a little bit by that announcement by Blue Owl about the further restriction of some of those dispersions. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Another interesting day on Wall Street. Stocks on the back foot, but they did finish the day off the lows of the day, but some key technical levels now back in play, including the 100-day moving average on the S&P 500, something to keep an eye on tomorrow, particularly at the open at 9:30, about an hour after we get that latest GDP report. Geopolitics did dominate a lot of the market sentiment today. You did see Brent crude prices up by about $2 here, and to 2%, I should say, back to around $72. That's the highest that we've seen since going back to July. Spot gold did trade back above $5,000 as well. Also dampening sentiment was some big moves that we saw in some of the alternative asset managers. Think Apollo and TPG and KKR and the others. You see that reflected in one of the main Bloomberg indexes that tracks those, and a lot of this had to do with an interesting commentary that we're going to talk about in a bit out of Blue Owl Capital.
Absolutely. We will be getting there, but let's talk about one bright spot on the day, and that's what we saw in Deere. Of course, they reported earnings a little bit earlier. You can see that shares flew higher, up about 12%. Some interesting comments there when it comes to margins, but still shares closing at a record high. A much different story when it comes to Carvana. Remember, they reported about 24 hours ago. You can see the shares down about 8% on the day. And then Blue Owl finishing the day about 6% lower. And that's our top story this hour, actually, rekindling concerns in private credit. Blue Owl fueling fresh fears here after the alternative asset manager said that it's going to restrict withdrawals from one of its retail-focused funds. Now, you saw shares of the firm, as Romaine said, with its peers, really dragging down the industry overall. And as Wilma, Burdis, and the team over at Raymond James said, that this sell-off is an overreaction. She has a strong buy rating on the shares. I'm pleased to say that she joins us in studio now. Wilma, it's great to see you.
It's great to see you too.
So let's talk about what exactly happened here. Blue Owl Capital came out today and said that it's going to restrict withdrawals from Blue Owl Capital Corp to OBDC2. Previously, there had been a plan to resume redemptions this quarter, but redemptions have been halted since about November or so. So what do you make of this reaction? I know that you say it's an overreaction, but it does speak to fears overall that are percolating throughout this industry.
Absolutely. OBCD2 is a relatively small fund, it's $1.5 billion of assets versus $300 billion for Owl. There's always been a plan for this fund to end up in a different type of structure. And the company is really doing its best to provide a good liquidity to those shareholders in OBCD2, not seeing it so much as restricting redemptions, more so giving them liquidity that is the plan that they've laid out for that fund.
And it's interesting. So the redemptions are one part of it. The other part is that Blue Owl also said on Wednesday that it has sold about $1.4 billion of its direct lending investments across 3 of its funds here. Now, those were sold very, very close to par, which is interesting. But there is this concern, or at least this theory, this, whatever you want to call it, out there in the market that perhaps they were selling the highest rated securities first. But tell us through what you make of this sale and where exactly it fell in relation to par.
Absolutely. They sold these assets at par. If you look at OBCD2, it's trading at 75% of par. And so that gives you a pretty good indication of what institutional investors who are able to see these loans are seeing. And that's a very big discount. We talked a little bit about loan to value last time I was here, 30%. Really assuming that these assets go down 25% is assuming that the underlying companies go down 80, 90%. So it seems a little far-fetched to me, and I think this validates, it's a good validation point on these assets.
Why isn't that be able to be communicated by the company itself? And I ask that because when you look at, I'm talking about with the investors in the publicly traded BDCs right now, they're clearly skittish. It's the job of any CEO, any C-suite executive for a publicly traded company to talk to Wall Street, to make them understand how the business is going. We've been talking about the issues with Blue Owl now for months. Why haven't they been better able to articulate what's going on?
I think if you look at what they've done, it's very positive overall. They're giving good liquidity to OBCD2 shareholders. They're honoring all the redemption requests on all of the funds, and that should allow investors to realize, hey, I can get my liquidity out of this fund. I shouldn't be so wary here. And I think that those are very positive things that they're doing. And this also gives a good validation that the loans are worth what they say they are and what they've marked them at. So all positives there.
All positive. So you're comfortable right now with the messaging coming out of management? And when we get in, 2.5 months or whenever they report again, do you think that we'll get maybe a more articulate message out of them?
I think we're going to continue to see good results, strong credit, good fundraising, all of those things. And if they can continue to provide those good results and excellent products, which they've been doing, I think that you'll see over time that the investors will become a little bit more comfortable with what's happening.
Let's talk about some of these investors, of course. We're talking about a fund that was really marketed towards retail investors. And I mean, Blue Owl aside, I wonder, whether you think some of these vehicles that retail investors are being offered private credit, whether or not those are the appropriate wrappers. Because you think about a lot of self-directed investors, they're used to daily liquidity at this point. And, to be told that even on a quarterly basis, you might not necessarily get that. You have to wonder whether or not that's being fully appreciated by the folks who are buying into these sorts of funds.
Absolutely. The products offer very strong returns on a fixed income type product, and I think for the right investor, it's a very good fit. That's a conversation that each investor has to have, but there's definitely a place for a very well returning, good performing credit product in a lot of retail portfolios.
All right, Wilma, great stuff. Great to have you.
Thank you.
Wilma Burdis, Director of Equity Research over at Raymond James. A closer look here, specifically at Blue Owl. I mean, at least for right now, that's where all the attention is. But I thought it was interesting how all of these other firms got dragged down. I mean, you could kind of understand why a couple of them might have been dragged down, maybe like Ares. But then when you see, you see Blackstone and Apollo and TPG, you're like, okay, do people understand really what's going on here?
Yeah, it was interesting. Yeah. I'm glad that you showed that index of a lot of these alternative asset managers just as an industry falling today. I mean, it'll be interesting. I know that, when it comes to some of the fundamentals of Blue Owl, there's a lot of things to point to say this isn't the end of the world here. But certainly that question you asked, whether or not management is able to effectively communicate that. That's certainly an open question. I have to imagine it's going to be an urgent one come reporting season.
And I raised that because I remember it was when they reported a couple weeks ago, whenever it was like, and we talked to an analyst and he was saying, look, nobody's expecting this company to go under. No one's expecting the end of the world, but they're just concerned about the transparency of what's really going on. And let's face it, I mean, if you're a publicly traded company, there's just, you have to open up the kimono sometimes and let people know.
Absolutely.
All right, when we come back, biotech stocks have actually started off the year on a pretty good run. The NASDAQ Biotech Index up about 5%. So far, year to date, we already had 3 or 4 big biotech IPOs just this month alone. We're going to talk with John Flavin, the CEO over at Portal Innovations, to get his diagnosis on the sector and where he's seeing the strongest vital signs. This is The Close on Bloomberg. All right, well, the biotech sector has actually started off the year pretty well. It's booming higher, and our next guest says it's causing some positive side effects for the industry's IPO pipeline, writing the biotech IPO window, it's cracking open. After a few very inactive years, you're seeing more early-stage startups heading towards the promised land. John Flavin joining us right now, the CEO over at Portal Innovations. And I ad-libbed a little bit on that last part, but let's talk about the opportunities there because, I mean, well, we know the IPO sector overall, to pick an industry was relatively dormant for a while. It's picked up a lot in other sectors.
Yes.
But we've seen a lot of activity, including at least 3 or 4 just this month alone.
Yes.
That continues?
It continues. And I think there's optimism and good reason for optimism for the continuance of 2026. We saw really a a big rebound in the second half of last year. A lot of this was driven by $138 billion of M&A activity by big pharma acquiring biotech companies. That, of course, returns more capital to those investors to recycle it into investing in the next generation of companies, including IPOs. So I think what you see now is coming out of the biotech nuclear winter that we saw coming out of 2021, a return to the markets. And I think we're also benefiting from a sector rotation away from the tech trade and into biotech. And I think generalists are returning to the space, which is good.
There's an IPO side of this. You kind of teased M&A, and I am curious about this idea of a patent cliff, maybe potentially continuing to drive that M&A. We've talked a lot on this show, at least with a couple of key companies in the weight loss space that are facing patent issues, and whether that might actually force them to take a harder look at something external.
No question about it. It's a big driver. And again, those M&A numbers we saw last year are really, a true measure of the need to fill that pipeline. You estimated to be around $200 billion by 2030. That's a pretty short window of time. So they're on a shopping spree. There's a lot of cash that they have to invest in these biotechnology companies to fill the pipeline. And the good news is the science is driving the opportunity for them to fill pipelines with novel, new types of therapies, cell therapy, gene therapy, new approaches toward breakthrough diseases that are now becoming more treatable, like Alzheimer's and various neurological disorders as well.
Well, Raymond mentioned that we're seeing some of those patent cliffs when it comes to the GLP-1 market. Of course, Novo Nordisk is facing some international patent cliffs there. But beyond, weight loss, where do you see the most potential for some of that M&A to refill pipelines when it comes to different disease, different treatment areas?
There's so much going on right now in inflammation and immunology, so that's a big thrust of a lot of the activity. If we look at, who were the major acquirers and what type of pipeline were they acquiring, it was mainly in the areas of inflammation and immunology last year. Cancer remains a really important part of the pharma portfolio. And again, these new modalities that are entering into the landscape, cancer vaccines, all of these new types of approaches to have a greater effect on cancer, CAR T therapies, are all driving value opportunities that are making them the appetite for big pharma to go in and acquire these pipelines. Lastly, cardiometabolics. Again, GLP-1s are driving a lot of the acquisition activity, looking for follow-on pipeline activities beyond the GLP-1s and looking for how GLP-1s might affect other disease areas that are also included.
Well, it's interesting. I mean, Novo Nordisk, they lost out on that bidding war for Metsera, but we know that they're in the market for a pretty substantial deal. So it'll be interesting to see when that comes through. But John, you mentioned that, you're seeing tourists come back into this space as investors, which is really interesting. I feel like we're starting to see something similar when it comes to energy as well. But when was the last time we saw a moment like this, where you are seeing these generalist investors actually perk up and be interested in this space again?
It's been a while. I think we did see quite a bit of activity during COVID, where you saw biotech enjoy a very strong run in the marketplace. And when those profits were being made and taken, generalists were coming in at that point. But it's been a couple of years. And usually, they're going to be the lagging indicators of what's going on in terms of what the prospective opportunity in biotech is. So with them returning to the space, I think it bodes well for continued liquidity, because that's always been an issue. If it's only the sector specialists, the so-called biotech mafia, then if you're in that particular situation, liquidity trading is a lot lower. And so it's a lot harder for market entrants to get involved and own big positions in these companies. So I think it's a really healthy activity. I think we'll look to see, what these IPOs are containing in terms of who's participating, as those public filings come out here in the near future.
I do just have to ask, I don't want to get too deep into politics, but I've asked you this before about some of the dynamics that have changed in Washington, particularly when it comes to the review of drugs and the approval of drugs, and at least more recently with regard specifically to vaccines. You're helping a lot of small companies hopefully become big companies, some of them working on vaccines. Is there worry here that at least in the U.S. there might be a direct path or maybe some certainty to approval, I should say?
Well, as you know, clarity, transparency, predictability are key elements and characteristics of a very healthy investment opportunity. And the current environment with regards to the FDA is a mixed environment. On one hand, really excited to hear Dr. McCary talk about his vision for improving efficiencies and cutting down the time it takes to get through preclinical development into human clinical studies. Right now in China, it's a lot faster. It takes 520 days to get to an IND in the U.S. to get into human clinical studies. In China, it's 200, moving to 60.
Yeah.
So looking at some of the programs he's developing, including these single protocols for pivotal studies, are all very beneficial.
All right, John, always great to see you. Really appreciate you stopping by. That is John Flavin. He is the Portal Innovations CEO. This is The Close on Bloomberg.
Keep an eye on shares of C.H. Robinson, one of the biggest trucking companies in the world, making a comeback despite last week's sector sell-off in the logistics space. What was it about? It was about AI disruption fears. But our Bloomberg intelligence analysts say that C.H. Robinson's data remains its competitive advantage in that AI space. Joining us right now is the CEO of C.H. Robinson, Dave Bozeman. Dave, great to have you here on the program. Now, of course, there was a lot of hay made about, the former maker of karaoke equipment coming out with this idea here that they have basically found a way to disrupt the trucking and logistics industry. An industry, let's just be fair, Dave, has been relatively fragmented, and certain pockets of it certainly are stuck in the past. But there is a case, at least that you and your folks are making with regards to C.H. Robinson. The AI is not only there, but it's been there for a while. Explain that to me.
Yeah, Romaine. Hey, first of all, glad to be here. Thanks for having me on. You're right. There is a case, and C.H. Robinson is making that case. If you look at where we are as a company, we've been on a transformation that includes three key things. It's our logisticians, our technology, and our operating model. We call that lean AI. And it's been a disruptor. Matter of fact, we say that we are the disruptor and not the disrupted. And that's why there's a big difference between perception and reality on what took place in the industry. Now, what's going on with us is, you're right, the data that we have is the largest data set in the industry, and we now have made that data intelligent. And we've used AI as a game changer for us. It's driven 40% productivity since 2023. We've outperformed the freight market 8 quarters in a row. And we're just getting started at Robinson and feel really good. The last 2 years have been super exciting. The next 2 years are going to be even more exciting. And no one's going anywhere here at Robinson. We're here to stay.
I am curious, though, too, with regards to some of the improvements that this AI, the lean AI, as you guys kind of brand it, and the way that it sort of factors into the ordering, pricing, matching people up here. Obviously, at the end of the day, you are still doing business with folks that aren't C.H. Robinson. So if they aren't tapped into that system, does that sort of negate some of the productivity gains that you have internally?
No, it won't negate the productivity gains that we have. We've really looked at it and said there's a quote to cash process that has a lot of friction in it. It was a perfect opportunity for us to use our technology and really go after those manual, mundane processes and reduced a lot of that, which we did, and that contributed to our productivity. But again, our data set is one that allows us to do business and do business, move our people to the right, working with people in more strategic fashions, taking away all the things in the back office. And we've done a really good job at doing that. And now we're moving forward to solve complex problems. And that's what we do as well as freight forwarding. But we're really a logistics solution set, and that's what we do at Robinson.
Well, it's interesting. I was reading a column from one of our Bloomberg opinion columnists, Thomas Black. He points out that, you're one of the large freight brokers who has really adopted AI already. He has a great stat in here that when it comes basically to the time that you need to find an offer on a load, it's been cut down to about 30 seconds from 17 minutes, which is pretty interesting here. But I'm wondering, how you continue to stay ahead of the curve when it comes to AI, which is continuing to develop and disrupt industries as we continue to see. So how do you stay ahead of the curve? Does that come in the form of, increased R&D spend, or how do you actually build that into your processes?
Well, thanks, Katie. One of the things that the team does really well, and we think is a competitive advantage, is we have internal engineers. We're a builder, not a buyer. And we take our internal engineers and we actually build our technology. Now, our hyperscaler is Microsoft with the Azure platform, but after that, we build all of our in-flow AI work, and that allows us to do what you called out, which is build 30+ agents that are mature. And the one we talk about is our quoting agent, and there are several more as well. But it's super important that yesterday we were doing quotes. It took us 17 to 30 minutes to respond back to a quote, and we would only get to about 60% of those quotes. Our engineers have built an agent that now can respond 100%, 24/7, and in 32 seconds. And this happens along the quote to cash process, and it's a competitive advantage because of speed. And we're able to ideate, experiment, and we do that because we have internal capabilities. And that makes a difference in this industry.
Well, as that time compresses, what does that mean for your workforce? Has that enabled you to reduce your workforce, or could you see that becoming a possibility in the future?
Well, productivity, we're an asset-light company. A lot of our costs is in variable costs, and certainly some of our entry-level, mundane processes that have been eliminated. Certainly, we've had productivity when it comes to those jobs are obviously engineered differently. But it has allowed us to shift our focus to the right, move our people up the value chain with our customers to really solve more complicated problems and drive more growth. And that's how we've looked at it here at Robinson, shifting the work, augmenting our people, supercharging them with that technology, and allowing them to solve more problems.
Hey, Dave, one quick question before we let you go. I do just want to get your thoughts more broadly here on what you are seeing in the trucking and logistics space. Obviously, given your role as an intermediary between the shipment of these goods, have you seen a material increase or decrease in activity?
Yeah, Romaine, it's a good question. What we've seen, first of all, we deal with 75,000 customers, and we do 37 million shipments annually. So a strong scale at Robinson. So we have a good take globally around the world. And what we're seeing is the key things that I watch are really manufacturing, retail, and housing on the demand side. That's what really generates freight and helps to drive the economy. And I think on those three, we haven't seen exactly the green shoots that I'd like to. From a housing perspective, obviously with reduced rates, we think that can be some help. But we have to watch the affordability issue on housing. On retail, that's been dislocated, and that needs to be get back in place, and because we have things coming in all over the world. Yeah. And obviously on the manufacturing side, we'll see that start to get, we want that to go up and to the right. Those three things will drive, I think, a rebound that you'll see, and we'll be ready for it here at Robinson.
All right, Dave, really great to get some time with you. That is Dave Bozeman. He is the CEO of C.H. Robinson. This is Bloomberg. All right, well, the Trump administration gathering Wall Street executives and government officials at Mar-a-Lago for an event hosted by the Trump family's crypto platform, World Liberty Financial, likely an attempt to reignite interest in cryptocurrencies and pave the path to greater clarity for digital assets, with key industry regulation hanging in the balance for 2026. Joining us live is billionaire venture capitalist and Bitcoin bull Tim Draper. He is the founder and managing partner of Draper Associates. Tim, it's great to have you with us, and looking forward to talking to a Bitcoin bull right now, because you think about when we were last at record highs above $125,000 per coin back in October. Certainly feels like a long time ago. In your view, what is the current state of the crypto market, and what is the bull case here?
Oh, I think we're running through this cyclicality that comes with the halvings, or what they used to be called the halvenings. And I think we're going to see a time here where people are, start to lose hope and all that. And then people will realize, hey, it's a better store of value. It's a better currency. It's a currency that you can trust no matter what happens with your government. Bitcoin keeps perfect records. It's transparent. It's open. Everybody can see it. So it's honest. And I think, and it brings humanity to a higher level. And I think we're going to see, I think it might drop a little more as as people have to unravel because they were a little too enthusiastic and they borrowed to buy more Bitcoin.
Right.
I think those have to be unraveled, and then it'll resume its upward trend.
Well, Tim,
so I'm very excited about it. I think it's the greatest thing that's happened to humanity. Yeah. It's so great that we now have another way for us to all do business, and it's like as big a deal as going from nothing to shells, or from shells to gold, or from gold to the promise of gold. Each of those made the world wealthier. This is going to make the world wealthier.
Well, Tim, it's interesting to hear some of your...
There is a gravitational pull toward Bitcoin,
right,
away from the other cryptocurrencies, and they become more and more marginalized each time there's a boom and a bust. And so I suspect that'll continue. Bitcoin will maybe end up being an 80% market share of all the cryptocurrencies. I think that's probably the way it's going to go.
Well, Tim, I do want to talk about some of your reasoning there, because it's interesting to hear you sort of going to a back to basis case for Bitcoin, because, you know, we talk to a lot of people about crypto on this show, and some of the reasons that they typically give us is we're going to have regulatory clarity. That's going to be the next catalyst for Bitcoin, something along those lines. I mean, do you see that as an actual significant factor here, or is it more, you know, back to the original promise of Bitcoin when it comes to being, you know, outside of government?
I think it's just natural that people will get very optimistic about something, then get pessimistic, and then they'll come back and they'll become more optimistic, and more things will evolve. And the regulatory activity in the U.S. is a very positive sign, and I suspect that positive sign will continue as various politicians recognize the value of having a currency.
I am curious, though, Tim, on that point about it continuing. I understand the current administration, but is there any concern here that if we don't start to see a more formalization of regulation and legislation in the next couple of years, that the potential a new administration comes in 3 years might not be so warm to crypto and could maybe hurt some of the progress?
Well, it might hurt. You know, when an administration comes in and over-regulates, it cramps down on the innovation in an industry. And there's extraordinary innovation happening around Bitcoin. And in fact, we have this Bitcoin Phi accelerator that brings in all of these new innovations. As those innovations make it easier for people to operate in Bitcoin than in dollars, there will be less and less of a need for a dollar.
Yeah. Are we going to see some of those folks on your show then when it comes back on the competition show you have?
On Meet the Drapers?
Yeah.
Absolutely. Well, of course, we occasionally have shows dedicated to Bitcoin, but generally Meet the Drapers is we go around the world and we bring in entrepreneurs, and about 1,000 entrepreneurs apply for about 4 slots, and then we work it to a big competition at the end, and it's fantastic. Yeah. And now we're doing kind of a Meet the Drapers with America 250. Yeah. We're doing America Startup. Oh. And that is going to be great fun. I'm doing that with Rosie Rios. All right. Well, I tell you what, Tim, you've got to come back on the program when we get closer to that 250th anniversary. Obviously, Declaration of Independence Day here in the United States. We'd love to see how that ties together. Tim Draper, the founder and managing partner of Draper Associates, of course, a bull on crypto, and the latest season of his Meet the Draper scheduled to come out in a few weeks. Meanwhile, a new show is also debuting in that same space. It's called The CEO Club. It's a new docuseries following a group of women CEOs navigating the challenges out there. It's on Prime Video. It's produced by, well, you saw her just there on the screen, Serena Williams. We had a chance to catch up with 4 of the cast members, including model Winnie Harlow. Take a listen.
Originally, Dee and Tommy And Talia and Tommy Mottola had come to me and said, hey, we've been speaking with Amazon, and there's a great idea of bringing positive programming to TV, and one that could really inspire people to really lift each other up and see that women can be in the hot seat and perform with speed bumps and a roadmap, but mountains that we have to climb. And I think that because we support each other so much and also lift each other up, you really get a behind-the-scenes look at what happens on the CEO Club, and we're really proud of it.
But give me a sense here of exactly what viewers are going to get. Is this sort of like a Shark Tank style? Is this more just reality show? Or is this more just really like, let's follow these people as they try to build and run their business?
I mean, it is a reality show. And it really does follow. All of us have different businesses that we are either starting a docuseries, reality show, whatever you want to. Well, but it definitely gives a behind the scenes of how we're managing our careers, our businesses, our children, how we're juggling all that. And it's done in a way that is a little bit different than I think what a lot of people see women being portrayed in reality series. We're all very good friends. We're all very supportive of one another. There's no toxicity.
Well, that's where I kind of was going to go. I haven't had a chance to see it, and I just wanted to make sure that you guys aren't like throwing champagne.
There's no air pulling.
Yeah.
There's no air pulling in this one. What there is, though, is there are a lot of fails in the show, and you see us recover from them. And that's really important because it's not all glitz and glamour. And as Winnie says often so well, it's not a highlight reel of what social media looks like.
Winnie, maybe you can expand on that. We talk with a lot of entrepreneurs on this show, and probably the most illuminating thing you learn from them is not the successes that they've had, but it's the multitude of failures that they had to get to that success. I mean, just in your career, particularly as building a business and building a brand for that matter, what has kind of been one of the failures that you had that you actually learned from and that were able to sort of transform that into some type of success?
Yeah, on the show, we actually get to see me go through a public failure, but I don't even like to claim failure because it's how you go through it is really what. Yeah, exactly. So we had some product packaging issues that were making the ratings of products go down, and it is a fan favorite product of the K-Skin line, the SPF lip balm, and we just had to pivot. And my co-founder Kim Perrell always says, "Fail faster." And so that always sticks with me. You're never not going to fail, but it's how you continue to push through and persevere that is going to make the difference on if you succeed or really fail.
Isabela, when you're coming up with an idea for a product, are you already thinking about who the target audience for that is, or does that come later? What's the process?
Yeah, so for me, my design, I design jewelry. So it's very important to design things that is timeless, but it's still a little touch of modern, something that's not out there, something that's different. So for me, I always think of my client like, what's a piece that they can add it to the layer, they can add it to what they already have that's gonna stand out. So my process is always creating things that is not out there, that is things that's innovative. And as well, things that is gonna make people like feel good about themselves and give them the confidence and like have a little memory to some things.
There is a function of this series, it's 8 episodes, called Shop the Show, where effectively a brand, the product that you see in the show, you can then go onto the Amazon app and actually buy the product itself. This is relatively new. I mean, it's not completely new, but I mean more so in the U.S. because you go overseas, particularly into Asia. You see this all the time now. Is that the direction where we're going now here in the U.S.?
I definitely believe so. I mean, with retail, as you know, with Saks going out, filing Chapter 11, and that I just think the landscape of retail is changing quickly, and I think that there'll be all kinds of ways to shop.
Yeah, live TV is definitely the way, though. I believe of the future, and I think if we're not on top of it, we just lose our customer because they're going to find somebody who wants that attention. They're gonna find somebody who can explain that product better. So live TV is definitely the wave of the future. I think it's the way to really settle in with your product.
I am curious about distribution. I mean, what's the path that you look for? Do you look through the traditional retail path, meaning a third-party wholesaler? Is this direct to consumer? Are you looking for kind of, some sort of partner to kind of take you global? Like, what's your approach?
Well, for me, we have our own distribution. We have over 180,000 salespeople who sell our product to over 4 million customers, and so we have a built-in network that we can distribute our products. But we actually sell K in one of our stores, so it's really cool that we can share that information with each other.
But for cosmetics too, I would think.
Yeah,
right?
definitely.
Yeah.
So I am in Sephora, so we definitely have retail, but DTC is also important, and I feel like you create a relationship with your customer when you have that direct to consumer.
For me, it's all of the above. It's all of the above. I mean, you need all of it. And of course, social media plays a big part in it, as well as AI is going to play a big part of it.
And that was Dee Hilfiger, Loren Rittinger, Winnie Harlow, and of course, Isabela Grutman. Of course, they're all cast members of the new docuseries, The CEO Club, which premieres on Prime Video on February 23rd. We're going to set you up for what to watch when we come back after the break. Stick with us. This is Bloomberg. Let's set you up for what to watch over the next 24 hours, and we start off in the morning with some big economic data.
Absolutely. We're getting U.S. PCE coming at 8:30 a.m. So too is personal income and spending, and of course that GDP figure that we've been waiting for, Romaine.
Yeah, it's going to be interesting to see not only what it says, but more importantly, how the administration spins it. We're also going to read at 10 a.m. on consumer sentiment, particularly out of the University of Michigan there. New home sales as well.
Yeah, looking forward to that. You see that mortgage rates, I think they're at a 3-year low or thereabouts. It's going to be interesting to see if that's translating into home sales. Speaking from personal.
Are they ever going to go back down to like 3%?
God, wouldn't that be nice?
It would be lovely.
Yeah.
We're also going to get some Fed speak. Bostic, who I think spoke today, is going to be speaking again. But hey,
Grab
2
the
days
mic.
in one is great. Actually, but this is going to be big. The Supreme Court reconvenes tomorrow, and really all everyone is looking at least in the world of finance, is at one big decision potentially that could come.
Yeah, highly anticipated. Of course, we've seen this delayed, or at least them not actually announce a decision a few times now. But of course, they've had this break. They're coming back. So maybe, of course, we'll finally get some clarity here.
Yeah, on the tariffs. In fact, the president quipping about it just earlier today, saying he's been waiting a long time for it. Well, Donald, so too have we. Of course, we will bring you that breaking news as soon as it happens across all of our Bloomberg platforms. For more on what's going on in the world of Washington and beyond, stick around. Balance of Power is up at the top of the hour.